This is Cece. Welcome back to the Orbit. This is part two of short duration and zero DTE index trading. We're looking at SPX. This will apply to, the lessons here will apply to most cash settled indices, especially short duration. Some of them may even apply to ETFs that are not cash settled, but we will go over the differences specific to cash settlement versus normal assignment exercise risk in other instruments like SPY and Qs and things like that. Part one of this, we looked at that specifically. We looked at the differences between SPY and SPX. In this video, I want to go over some trade management concepts. And what we are going to do is we are going to start with one of the negatives of SPX that we talked about in video number one. There's a lot of positives to SPX. It's the cash settlement. It's why it is so popular in short duration trading is you don't have the same types of assignment, pin risk, things like that that you do in SPY and Qs. And that's why a lot of traders gravitate towards SPX when it comes to short duration trading, especially when you're playing credit spreads close to the money, things like that, or even debit spreads that might go in the money and might not be max gain. They might be in between strikes. But what we are going to concentrate on to start is one of the negatives of SPX, and that is the strike width. And the strike width is $5. And therefore, doing trades can mean, especially if you're a credit spread trader, it can mean risking a lot to make less. And we are going to go over, we are about midway through a trading day here. You can see what the SPX has done. We are looking at a 1 week chart. Let's zoom in a little bit. This is a 2-day chart. We're sort of trending lower, and this is the 1-day chart where we are down on the day, but not by much. We are about unchanged. Here's where the day started. We are down from yesterday about noon. You can sort of see this pattern, right? In the trades, what we have is we have an Iron Condor that was placed earlier in, which was about 20 minutes after the open. It was done at about the, let's call it the 15 delta level to the upside and downside, a little bit outside the expected move at that time. As you can see, the SPX has gone pretty much sideways. It's down, maybe 5 points below. So right now, as of now, this Condor is performing well. You can see its current value is 35. It was sold at $1, so it's $100. Currently, we're $35 on a one lot, and the profit is about $65. So we're going to talk a little bit about trade management here. So obviously, at any point, one could just close this entire trade, exit the entire position, maybe pay right now, maybe try to get filled at around 30. You might have to trade up higher to 35 or 40 to get filled right now, but you could sort of wait on this. This would probably be about $30 with the SPX in the same spot, maybe a half an hour, 45 minutes from now, that theta will continue, and this expected move will narrow as we get closer and closer to the close. But what we wanted to talk about is the various ways that you could maybe manage this trade without just paying for all four legs. And the answer is yes, you do. Obviously, you could just close one side. You could close the put spread. You could close the call spread. You could do that in a way where you sort of leg out of it. Let's say the SPX went up, let's say 10 points. Let's say it was trading up closer to 50, 80. Maybe you could take off the credit put spread at that point for next to nothing, 10 cents or something like that. And then let's say it went back down to here or even a little bit lower, down to 50, 60. You could maybe then leg out of the credit call spread side at about 10 cents. Now, the issue with that is you're obviously making a lot of trades, and a lot of people want to avoid that and avoid having, in and out in the same day. But what are other options that you have? And we're going to go over that a little bit right here. So let's take a look at the downside of the credit put spread. That is this put spread right here. We're short the 50-45 and we're long the 50-40. Let's say we were we were thinking, back to the chart, that the risk is to the downside, maybe that pattern that we were looking at a little bit earlier in SPX. If we were worried about that continuing, that two-day pattern of kind of, this sort of lazy move to the downside, if this were to continue, and we say, all right, well, the risk on this condor is maybe to the downside. The expected move here at this moment is 50-56 into the close. So it's not really threatened, but that's not that far away. If this SPX made a move down to 50-55, that's only 10 points away from our short strike. So what are our options here? Again, we mentioned you can close the entire thing. We mentioned that you can close just the credit put spread side. But there is a way to do it in a synthetic way that is an opening trade, and it is not a round trip of any part of this trade to take off the risk and essentially lock it. And this is unique to a cash settled instrument. You can do this in any symbol theoretically, but the issue with what we're about to talk about is in cash settlement, you do not have to worry about things like pin risk, and we can cover what pin risk is after we sort of discuss the 5, 50, 40 credit put spread as part of an Iron Condor. So what we would be looking to do here is we would be going into a credit call spread, right? And we are going to select today's expiry. It's going to generate a credit call spread out of the money. What we're going to do is we're going to take this down to the strikes of our credit put spread, and we'll discuss what's going on here. So as you can see, this trade selling an in-the-money credit call spread well below where the stock is trading, and we would be risking about 30. Now what this is doing synthetically is, remember the credit put spread. The credit put spread, we are short the 50-45 strike, and we are long the 50-40 on the put side. What this is, at $470, you would basically be synthetically closing the credit put spread at $30. So let's say you originally sold it at $50 as part of an Iron Condor that was $100. You would be taking the profits on that credit put spread synthetically. You would be taking about $20 in profit in. You would be paying $30, and your risk would be closed for the day to the downside on that credit put spread at this current price. And therefore, down below that level, nothing matters, because the credit call spread, even if the SPX went down to 5,000 into the close, the credit call spread would be max gain, and the credit put spread would be max loss, for a net difference of $20. Now let's get to why this is specific to SPX and cash settled instruments. So if we were to do this in SPY, the difference would be, and let's just go to SPY and discuss this. So if we were to do this in SPY, and we were short, let's say the let's call it the, what do we got here, 504. Let's say it was the 504, 503 credit put strike, and we wanted to do what we just talked about, and we did a credit call spread that was buying the 504 call and selling the 503 call. That would be taking us out of the risk in the same way that we just discussed in SPX. However, you have what is called pin risk, and that is just one of the few risks here. If the SPX just went sideways and you finished the day, nothing would matter. Neither spread would become in the money. But if it down to 504 in SPY, and you were short a 504 put and long a 504 call, you have what is known as pin risk, and that is you would probably end up having to close both trades because you would want to avoid the uncertainty of whether you are going to be assigned the 504 put, or if it's not assigned, depending on what happens after hours in particular. And then you would have the uncertainty of whether you knew, let's say it finished 504 and 5 cents, and then after hours it was down 10 cents and it was below that 504 strike. You would have that uncertainty. Do I exercise the 504 call because I don't know if I'm going to be assigned on the 504 put or not? And that kind of uncertainty does not exist in SPX, because SPX in that scenario, if it were to finish 10 cents or $1 above the strike, then it's just cash settled, and it is settled at that level of the SPX closing print on both spreads. You don't have to worry about exercise or assignment after hours. So how do we do the math on these trades? Luckily, it is quite easy. And again, we're back to SPX, and we're looking at a $5 wide. This is the credit call spread side, and this would be theoretically to close out the risk on the credit put spread of the same strikes. The way to do the math is that this max risk is the equivalent to the current max gain if you were doing the credit put spread side. So if you were closing the credit put spread, and you can do this, you can price out what it would be to close the credit put spread side, and you can quickly do the math, and these numbers are basically reversed. So last somewhat cheeky way to manage short duration is to place a debit spread in between your condor. And we'll go over that in a second and exactly how the math would work. So what we're going to do here is we're going to spin up a call spread for today's expiry. And remember, our strikes to the upside are we are short the 50.95 strike, and we are long the 5100 strike. We have a credit call spread at the 95 short strike level, right? And the SPX right now is trading about 50.60 or 50.65. So what we're going to do is we're going to take this call spread, and we're going to make it an out of the money call spread. So let's first take a look at the 70.75. Let's move this up a little higher, closer to our credit call spread, right? So now we are just below our credit call spread. Our credit call spread starts at 50.95. Right now, a 50.80, 50.85 call spread, we can take it up one more strike, and now we are looking at a 50.85, 50.90. Okay, so this is what I want to refer to, is this trade. Let's say we could get this for $15, or even if it was $20. Remember, we had sold that credit call spread roughly at $50. So by doing this debit call spread, we have taken off the risk of that credit call spread. Let's say we paid $20. We would have been locking in a $30 profit. Now, here's what's interesting about this trade, though. If the SPX was going to rally into the close, and let's say went to 50.90, or anywhere between 50.90 and 50.95, we would actually make max gain on this debit call spread. We would make $480, and then we would continue to collect that $50 from the credit call spread, and of course we would have collected the $50 from the credit put spread, the $100 in the Condor. This is an opportunity to take off your risk, and if you were to get a move higher, short of your short strike on your credit call spread, but in the money, putting your in the money debit call spread into the money, you could actually make up to $580 on the day. Now, there's a caveat to this. If this SPX were to go up above your credit put spread, and it was to say, let's finish above 5,100, remember our credit put spread or credit call spread stops at 5,100. Let's say SPX closed the day at 5,105. We would have max gain on our debit call spread, and we would have max loss on our credit call spread, right? And therefore, the math would be simply whatever we paid for this debit call spread to take off the risk to the upside, we would subtract that from our overall original credit received. And so in this case, our Iron Condor would have collected $1 or $100, and we would have paid $20 to take off the risk to the upside. So our net credit, our net profit on the day would be $80. But this has the opportunity to make a lot more than that while closing out that risk to the upside. And let's say we did this and we paid $20 to the upside, and we did this on the same side, on the put spread side, on a rally. We could theoretically be taking off the risk, paying, let's say, $40 for this trade, and having the opportunity to make a lot more if the SPX moved towards one of these short strikes of our Condor without actually going through it. So that's a cheeky way to take off the risk as well by opening up new trades. Now, what would that look like? Let's say if we did it both sides, you would essentially have Iron Condors or an Iron Butterfly, if you overlap that strike, on each side. And so you would be max gain of the net debits and credits you received on the trade if it went sideways into the close. But if it made a move towards the exterior, towards the wings of all these strikes you would have out there, you have the opportunity to make a lot more because you essentially have two Iron Condors on each side or Iron Butterflies. And the opportunity, your max gain obviously would be spread at the top of this debit call spread or at the bottom of the debit put spread without going through the credit put spread or credit call spread of the original Condor.